Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about the 5 biggest factors of retirement planning. And I would argue that maybe as much as 4 of them are rarely spoken about.
Or if they are spoken about, we only go like surface deep.
So before we dive into that, though, Alex, what are you drinking right now?
Today, I am drinking a triple from New Belgium. How about you, Ryan? What are you drinking?
That's a solid one. So I'm drinking a local brewery in Snohomish called Haywire. It's a great spot. I'm drinking their Northwesty IPA, which I don't have the can because it was a growler, but it is one of my favorite IPAs that I enjoy from them. So check them out if you are in Washington, up in Snohomish. There's several good actual breweries up there. So
For sure. Cheers, buddy.
Cheers, man. Well, hey,
this is actually a glass that I made myself.
Looks deformed.
It is slightly deformed.
But I have so many places to go with that, but I'm not.
It's green for my sounders. So that's why there's the weird tint on it, but like it's designed to hold a 22-ounce beer.
Love it. Love it. Well, let's dive into it today, Alex. So what's really interesting is, and even you and I, earlier in our career, probably from a financial planning perspective, for the way we were taught, we were focused on really one area. And that area was really, how big can we get our clients' nest egg or net worth? How big can we get it?
Right. When there was a commercial maybe about 5 or 10 years ago that was, it was talking about how people solve corporate problems. And the concept was build a catapult and put a whole bunch of money in a bag and load it onto the catapult and then fire the catapult.
And chuck it. Yep.
And so like the tagline was, wait, so you're telling me to just throw a whole bunch of money at the problem? And the guy was like, yeah, that's it. And that's the thing, is that most people have been taught like the only thing that matters is how big of a pile of money you can create at retirement. And that's one of 5.
That's one of 5. And what's interesting is where does that conversation normally start and for the most part end?
Rate of return.
Rate of return. Hey, let me talk about how we can invest your money and let me talk about what rate of return we can get you, right? And I'm sure they brought in allocation, risk profiles. I'm not saying it was just rate of return, but in the end, the end result was, here is your nest egg based on the rate of return that you're going to get. And it's a factor. It's an important factor too. I'm not saying that it's not an important factor. It's just not it's not the only factor. Let's say it that way.
It's not the only factor, and it might not even be the most important factor. Now, we can't do anything without a pile of money, but at the same time, like the other factors of like, okay, the location of where our money is, how much liquidity we have, what's the tax distribution status, what's the tax strategy that we're using for distributing or creating cash flow. Like all of those have really big weightings as to how much cash we can actually create in retirement and how aggressive or conservative we need to be.
And what's really interesting, so Alex just went over the 5 factors, and what's really, really interesting is like, for those of you listening, either you're a client or you're not, you just have found us wherever you found us. I'll have you ask yourself this question: why are you saving money to begin with? It's pretty simple, actually. You're saving money so that you don't have to work anymore. And have to work. You may want to work, but you don't want to have to work because you've got enough money or assets sitting on the sideline that can turn on an income stream to you that allows you to live the life that you want to live.
Whether it's sending kids to college, whether it's not working yourself, whether it's passing wealth on to the next generation or to a charity, you're saving money for a future use.
And when we think about it from that perspective, let's just think about your income right now. Our income is guaranteed right now for the most part, right? You might get laid off, but there's a level of expectation that we can reasonably count on that money coming in the door for the most part. There's tax concerns that we've got. We make X amount of dollars. We want the most of that to land in our checking accounts so that we can live the life that we want and build the wealth that we want and take care of our family the way that we want, right? As well as we're that net after tax income, as we're building that wealth, maybe there's legacy objectives there as well. And we want to do that in the easiest way possible, hopefully with the lowest amount of risk possible.
And that doesn't change when we get to retirement. We still want the highest amount of cash flow, the lowest amount of taxes possible, never worrying about running out of money, achieving whatever our legacy goals are, and not having to worry about whether the market is up, down, or sideways today.
So, Alex, I know we normally end on the question of the day, but it might be a great way to start today's episode. So I'm throwing you for a loop here. But
You're good.
Here's the question that we want you to ask yourself. Based on your current plan, or let's just say where you're saving money, are you thinking with the aspect of building those assets to turn on the income stream? Are you thinking about how the income stream will be best turned on net after net, how much money will end up in your pocket with that risk profile that you want? Are you even thinking like that? Are you only focused on how big can I get my pot of money?
Let's even start a simpler question. Do we even know how we're going to create cash flow in retirement?
Which leads us to the other four things that Alex has already brought up. So Alex, let's dive into it. I'm going to share my screen here so we can have the backdrop of someone's balance sheet here. So we're looking at a married couple. They make $400,000 of income. They're saving 68 grand a year, right? And as you can see by their balance sheet, the vast majority of their savings have gone into their retirement plans at work.
And this is what we oftentimes see.
And that's not to say that that's bad, because they saved money. Like, they're already ahead of the game from that standpoint. But the question that we always ask is, why did you choose to put the vast majority of your money in a traditional 401k, meaning you haven't paid taxes on those contributions, you haven't paid taxes on the growth, and when you pull the money out, you're going to get taxed? How did you choose that? And the answer we always get is, well, that's what I've been told to do. Right? And so that brings up so many questions around, well, should it be what you do?
And it's not necessarily like one of the things that when we ask that question, we normally get clients looking at us like a deer in headlights of like, I don't even know what questions to start asking, guys, let alone how to answer that one. Oftentimes we get questions like, well, aren't I going to be in a lower tax bracket in retirement? And that just, it is something that is brought up and talked about a ton. And the assumed answer is yes. But the real answer to that question is, well, compared to what, or compared to maybe a better question would be when.
Yep.
So if you're just graduating college and you're like 24, 23, 25, like somewhere in there, what's your income at that age compared to what your income is going to be towards the end of your career or even in retirement? Like, hopefully we're at a higher level of income comparatively at retirement. We've increased our standard of living. I don't know how many people like remember what it was like when they were in college, but for me, like, we would oftentimes be eating top ramen, or we were poor college students, and yeah, we had fun, but at the same time, and we had like actually a bunch of free cash flow, but that was because we didn't have much in the way of obligations.
So this question is okay, why'd you put money there? Well, it's the question is around location of your wealth, right? And it's not to say that you shouldn't have money there. It's more of, okay, what's the plan? Like what's the plan for this year? What's the plan for 5 years? And obviously into the retirement aspect. And too often when we ask these questions, I ask, okay, has there ever been an opportunity that you wanted to take advantage of, but you didn't have the liquidity or access to money to take advantage of it. Right? Everybody hears about the emergency fund. So like, okay, I've got my 3 months of expenses sitting in my savings account, right? Like that's what we always hear, but we don't hear, we always hear the people like want to take advantage or jump on an opportunity, but all of their money's tied in their retirement plan. And while they can take a loan out from that retirement plan, they oftentimes don't because they don't want to take the loan out. They don't want to pay the money back, all of that kind of fun stuff, right?
They don't want it to affect they don't want it to negatively impact their taxes. They don't want it to negatively impact their cash flow. They may not know that they can do it. They're not certain about like, okay, what's that going to do? What's the costs? And like, it just adds too many variables for them to feel comfortable with it.
So that's location wealth. And that's going to tie into a lot of the other factors here, because the next factor is, and we've kind of already brought it up, the true liquidity ratio. By true liquidity ratio, what we're talking about here is not from part of it is access to cash today. But what we're also speaking into is when you get to retirement, how much of your income in retirement do you want to be affected or controlled by the rate of return that the market's providing? And what I mean by that is, like, what do the stereotype people say? They say, okay, put all of your money in your retirement plan. Make sure you allocate less aggressively because you're in retirement. So maybe you're in a 50-50 allocation, 60-40 allocation, meaning, stocks, bonds, 50 stocks, 50% bonds. Well, stocks and bonds go up and down. So if they're going up and down and you're turning on an income stream from them, do you at all freak out when the market's down?
Well, and the idea and thought is, well, they both shouldn't be going down at the same time because they are designed to not work on the same principles. Bonds typically work off of interest rates, and stocks typically work off of the expected future of the economy. And it's not often that these things work in the same direction, but sometimes they do. And when they do, it can be devastating. I mean, look at 2022 when the stock market was down 15 to 20% and the bond market was down 10 to 15%, depending upon like what you're considering the market to be. And like, holy cow, that was a rough year for folks that were trying to retire right about then. And what happens in the first 5 years after retirement or the 5 years prior to retirement has a massive impact on what the rest of the trajectory looks like and what a quote unquote safe withdrawal rate actually winds up being during your retirement years.
I make the joke, and Alex has joined with me around, like, do you want to rely upon hope? You hope that the market works out in your favor when you decide to retire. And so bring this back to the true liquidity ratio that we're talking about here. You want funds that are not correlated with the market. And you want to start building them sooner rather than later. And the question that we often get is, okay, if I'm 35 years old, should I really be putting money outside of the market because I'm losing out on rate of return?
Well, the answer becomes, okay, well, how much are we losing out on if we need to create that true liquidity bucket at 55, 56, 57, 58, 60, 61, 62, like right before retirement, and the market drops 10% or 20%?
What control do you want to have of when you retire, which is our entire point? Like, a lot of people are like, okay, I'll just wait till I'm getting closer to retirement to do that. And the problem with that is, as Alex just relayed, Alex and I don't know when the market is going to go down.
Because it's all based on future information that is unknown and unknowable.
So if you decide, okay, I'm going to be extra cautious, and I'm going to do it 5 years till I plan to retire, you don't know if that 5 years prior is going to be the first part of the downturn.
Right.
And you also, and this is skipping ahead around distribution status and strategy. If you've got an asset that's not correlated with the market, what does that allow you to do with the other assets that are correlated with the market? Right. So again, it's efficiency and leveraging where your assets are. So that's what we mean by true liquidity ratio in that. We've had a whole episode around that piece. So make sure you go back and check that episode out. We'll put those in the show notes. Now that gets us to distribution tax status, Alex, which I think oftentimes people have spoken into, people in our industry and even uh, Americans, right? When they hear that, I think they think of, well, I put money in a Roth, I put money in a traditional 401k or IRA, so I've got some tax-free money and some taxable money. That's what they hear when it comes to that.
When they automatically think that they're going to be in a lower tax bracket in retirement. And we talked about, we alluded to this earlier, compared to when? Like, at what point on your growth of income over time does your retirement income surpass what your current income is? And so Ryan's pulling up a tax chart right now. And so if what we wind up doing is we take a look at what happens over time, most of the time, the answer is that somewhere between mid 50s and early 60s, depending upon when we're going to retire, is when we cross over that threshold and we're now making more during our working years than we will in retirement. So Ryan pulled up an example here of $400,000 being taxable. Even if we wind up dropping down to $320,000, 80% of that, we're still in the 24% tax bracket. And we only saved our, Ryan, on the next screen over, show 320 and 320. And so ultimately, like even in this example, it wasn't until we crossed $383,901 before we're in a lower tax bracket. Now, in this example, that $80,000 of less income saved us about 20K worth of taxes, but that's not necessarily often going to be the case.
But this is whatever, and this is accurate. Like the thought around if you can retire and you only need 80% of your pre-retirement income, like we're showing you here, right? $400,000 pre-retirement, like your last year of working, then you retire and you only need 320. You're right. You went from a 32% marginal tax bracket down to 24% marginal tax bracket, and you saved, in this example, $20,000. However, and this is what Alex is jumping into, could you have done better?
Well, and here's the thing, Ryan. In this example, if we're getting a 4% growth on our income every year, it was 2 years prior that we were in the same tax bracket.
Yep.
2 years, taking $400,000 future value backwards at 4% got us down to 370, which put us in the exact same tax bracket, like rerun the scenario 2 at 370 and 370. And in this example, we're going to wind up in the same marginal bracket, meaning that we wind up, so if we're comparing 370 to 320, we're in the same marginal bracket. We have a 24% benefit by taking the tax deduction. And so, it's a lot closer to retirement that we wind up in the same tax bracket. And when we reach that crossover point and start paying more in taxes than most people realize. The other thing that most people don't realize is that when we get to retirement, the rate of tax that we pay on all of our money is entirely dependent upon how much of it is taxable. And the less amount of it that is taxable, the less amount of taxes that we have to pay on all of our sources of money, like Social Security, like how much we pay for Medicare, like all of the different sources that we have, whether that is pensions or whatever else, are all affected by how much of our money is going to wind up being taxable in retirement. And so what Ryan just did is he took a look at the current tax allocation versus the future tax allocation of where our money is being put.
So for those of you who are listening, right? So in this example that we're sharing, this couple is saving $46,000 into traditional 401k retirement accounts, right? They're putting another $12,000 into savings and $10,000 into investments. They had started with the Roth account early on in their career, which is now at $47,000. But when we look at the allocation of their money and how it's taxed, right? They've got $900,000, so 58% of their current assets is going to be taxable, fully taxable when they take income stream from that asset. They've got another 38%, almost 39% of their assets, $600,000, that is going to be partially taxable. And then they've only got 3% of their money that is going to be tax-free or non-taxable when they pull the money out. What if they transitioned, and as opposed to doing $46,000 in traditional, and they did $46,000 onto the Roth 401k? Now you can see how their balance sheet from a distribution tax status has significantly changed. Now their fully taxable money is only 40% compared to 58%. Their partially taxable money is 33%. And now they have 27% of their money non-taxable in retirement.
Which is going to help them on their taxation of all of the distributions that occur. And it may wind up even knocking them down more tax brackets or make less of their partially taxable money. Like that's going to affect that tax bracket. It's going to affect a ton of different components. And the rate of tax that they pay on all of their money will wind up being less simply because more of the dollars wound up being tax-free in retirement. They've also got a lot more choice and flexibility with if there's a one-time big expense that pops up. If we're on the left-hand side where all of the money is either potentially partially or fully taxable, we don't really have a whole lot of choice. We're paying taxes on a lot of the distribution that we're taking out. Whereas over on the right-hand side, we've got a lot more choice as to what's happening with the extra dollars that we have to pull out for whatever the emergency was, whether it's a one-time trip, something good, a one-time opportunity, being able to help the kids or the grandkids, or whether it's, something negative like having to pay a big medical deductible or whatever else.
So this is tax status, which then takes us to tax strategy. And so I'm going to go back to the tax charts here. So if we go back to the 320 of cash flow in retirement, as we've been discussing, and we've already shared, they're 100% right from the standpoint of they'd be in a 24% marginal tax bracket rather than the 32% marginal tax bracket in pre-retirement. But what if with strategy, you still take 320, right? Once you hit 320 minus, I'm going to round up $75,000 in taxes, Alex. That's like
hit recalculate, Ryan. You're still
did it not? Thank you. So 320 minus $63,000 in taxes, right? We're looking at, what is that?
260.
260 net take home. What if with strategy of the 320, $200,000, and I'm making up numbers here, $200,000 is taxable. Well, now their effective tax rate is now 10%, almost 11%. Their tax bill that year is $34,000. So 320 minus 34. Now we're looking at $286,000 net take home. Right? What's the difference in that's like $30,000 more dollars net take home via strategy.
Yep.
So which would you rather have? Would you rather, you'll be in a lower tax bracket for sure, and you get to save, the $15,000 or the $20,000. Wouldn't you rather save more? Because sometimes we can make it look as crazy as this. Maybe the taxable income is 200, and maybe the gross number that you're actually taking out is 40.
400.
400. Thank you. So of the $400,000 of income, with strategy that this person's taking, only 200,000 of it's taxable. Now our effective tax rate's 8.5%, still in the same 22% tax bracket, but they're only paying $34,000 in taxes. That comes with strategy, making sure that we've got proper risk on the balance sheet and proper risk mitigation on the balance sheet. That true liquidity ratio and strategy around turning on income allows us to do versions of this rather than the standard approach that we constantly see out there, pile up all of our money, We take some version of an interest only off of the nest egg, and we pay taxes on all of that income. And we're still dealing with the market's rates of return.
Yeah.
And the emotions that go with that. Right? And even if they're up, like we just recorded an episode around elections, right? And that people are emotional right now about that. Are you less emotional around just a bunch of things, politically, economically, right? Because you set your balance sheet up appropriately, that you have the flexibility of the strategies that we're discussing right now.
Absolutely. So we mentioned it earlier, and we'll rephrase it a little bit differently now. But our question today is, how is it that you're planning to create income, or maybe more appropriately, cash flow in retirement? And if you don't have an answer to that, ask your current advisor, how are we going to create cash flow? Or set up a time to talk with us and talk about what are the different ways to go ahead and create cash flow in retirement, where we can do exactly what Ryan is showing here, where we're increasing the amount of cash flow that we're able to create and decreasing the amount of it that's taxable.
So in the show notes, you'll see a website link, beerandmoney.net. That'll take you to our website for the podcast. Here at the top of the page is a contact us page if you wanted to reach out to us to maybe even get a one-on-one consultation with us. Or if you have questions from today's episode, it's a great way to send us an email for those questions so we can answer them on the episode. Look, we started this podcast to help you think differently about your money so that you can live the life that you want, right? I hear all the time from clients, and Alex does too, where clients sit down with us and they're saying, I'm sick of making my company wealthy and not myself. So let's have a focus on being able to live the life that you want and the lifestyle with the income from today and tomorrow. As always, we hope this episode is valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7382998.1. Expiration date November 2026.